Alright, ladies and gentlemen, I've been making stock videos for a couple weeks now, and I get a lot of questions about what the indexes are. What does the S&P 500 mean? What does the NASDAQ mean? What's the Dow Jones? So I figured I'd make a video going over the basics of index investing and what the indexes are. So yeah, that's what we're going to be doing today. You should definitely do all of your own research. Do not take anything I say as fact. I just know what I know. I'm not an expert or anything, so do your own research, but I figured this is a good place to start for people that just don't know what any of this stuff means, so let's go. Alright, so truth being said, index investing is, in my opinion, a great way to benefit from the overall growth of the stock market without having to become a financial expert, and in a bunch of stocks, stay up to date on which ones are underperforming, portfolio management, weighting, all that stuff. Basically, when you invest in an index, it tracks like the average performance of a group of stocks that is gathered in one way or another. So it just kind of takes a little bit of that single stock risk out of the equation and allows you to invest in, the overall stock market together. To show you guys what I mean, I'm going to just use this example. There is an index that a lot of people talk about called the Dow Jones. And the Dow Jones, whatever people call it, is basically just the term for this index, which tracks 30 companies. So these 30 companies, the average movement of all 30, up or down on any given day, is the movement of the Dow Jones. Now, if you wanted to invest in this average, right, in theory, you could go out and buy all 30 companies yourself individually, but, over time, companies get added, companies get taken off, some underperform, some overperform. And sure, maybe you're going to get lucky and pick an overperformer and, owning all 30 you could do yourself, but there's a way to do it where you can buy an index fund that is just automatically going to hold all 30 of those companies and adjust it as the Dow Jones changes itself. So instead of investing in a company that maybe does better or worse than the Dow Jones, you would buy this ETF that tracks it overall, and you would get the average performance of all 30 stocks over a period of time. And so obviously, unless you have the time to really become a massive expert in hundreds of companies and have a consistent way of picking overperformers, buying an index is a good way to just get the overall movement without as much of the downside risk of owning one stock. So basically, index funds allow you to diversify your investments pretty easily. They're pretty set it and forget it once you buy an index. The goal is to not worry about it very much because it's going to just, as long as the U.S. economy is bigger in 10 years than it is now, then your money is going to grow. Anyways, that being said, that's the basic of what an index is and why they're a good thing. But there's a couple different indexes that are important to know about if you're going to start following, the stock market, news, all that stuff that just makes it a little bit easier. So I'm going to just go over those now because when I first started, it took me a little bit to understand exactly what was going on. So the first one that we're going to talk about is the one I used in that example, which is the Dow Jones Industrial Average. Woohoo! And like I said, this index is comprised of 30 companies, and this index actually started tracking in 1896. So it's pretty old. It's actually the second oldest index in the United States. And, things have changed a little bit since 1896. It wasn't always 30 companies. It's grown over time. Companies have changed over time, but it's an index that dates pretty far back. And what it really focuses on is it tries to find companies that are more established, maybe not as much in that growth phase and have more stable earnings. And so a couple of companies that fit this bill are just ones that are included in it right now. These are just a couple of the current members. Chevron, the oil company, Caterpillar that makes construction equipment, Coca-Cola, JP Morgan and Chase, the biggest bank, Microsoft, Verizon, and Disney. So they tend to focus more on companies that are a little bit more established and older. However, there definitely are some critics to it, A lot of people say that 30 companies just isn't enough to get the overall movement of the market average, It's too few companies to get a real representative average. And I think, obviously, you should do your own research before you invest in everything. This is just the basics. So, do your own research before you buy anything. That being said, the Dow Jones does have index funds available for it, and the two biggest ones that I could find from my research seems to be the DIA index fund, that's the ticker for it, and that's from S&P Global, which is a huge company, and then IYY, which is iShares, which I believe is BlackRock, one of the biggest investment banks in the world. Obviously do your own research, but there are index funds that do track this. Next up, this one is probably the most important one currently as of the time of recording this on, January 15th, 2022. The S&P 500, or the Standard & Poor's 500. This is basically the granddaddy of all indexes at the current moment, and it tracks 500 of the largest companies in America. So obviously a few more companies than the Dow Jones by 470. And most people say that this is kind of the gold standard of indexes because when you're tracking 500 companies, it's pretty representative of the market overall. Obviously, the average performance of the stock market recently in the last 10 years has been pretty impressive. And if you were investing into the S&P back then, it's done pretty well, which I think is a big reason as to why so many people love it so much. A lot of people say, though, that the way that this fund is organized is by weighting, like by different market caps and performance. So theoretically, if a particular company of these 500 goes on a crazy hot streak, it could create a bubble in the S&P 500 because as it does better, it would slowly become more and more of the weighted of this index, or the weighted overall value of this index. And what that means is, like, for example, if Apple goes on a tear and goes up in value, it would become a bigger percentage of the S&P 500. So if one of these companies became 20% of the S&P 500, just for this pretend example, and then crashed, well, obviously 20% of your investment having a problem would cause the value to go down. That being said, there's a lot of dispute whether or not indexing is going to cause bubbles or if this is a massive issue. Do your own research before you invest in anything, but that's just the basics of the S&P 500. As for ETFs that track this, there's a ton. Like I said, this is kind of the gold standard at the current moment, but the two biggest ones from most of what I've seen, you have SPY, SPY, which is from the Standard & Poor's company, and you also have VOO, which is from Vanguard. Both of those are massive financial institutions, and there's a lot more out there. Like I said, do your own research. Those are just the two that I hear people talking about the most for the S&P 500. The next major index is the NASDAQ, or the NASDAQ 100. People kind of call it some different things. And this particular index is made up of the 100 most actively traded companies on the NASDAQ stock exchange. There are different stock exchanges. Obviously, the most famous one is the New York Stock Exchange. But NASDAQ is just one of the large ones that's popped up within relatively recent times, within the stock market term of history. And it tends to be a little bit more technology focused. There's actually no companies allowed in this index from the financial industry. So, whereas a lot of even components of the Dow and S&P 500 are involved in banking or finance in one way or another. Because they're not allowed on this, a lot of the representation of the index tends to skew a little bit more growth heavy. For example, as of the time of recording this, 56% of the NASDAQ 100 is technology related in one way or another. So it tends to do very, very well when technology is performing very well. However, the last, this year so far has been pretty rough for the NASDAQ, just because there's certain economic factors well outside of companies' control that can kind of impact technology companies more than other companies, which is really the downside that most of the critics talk about. You're subject to a lot of potential downside if interest rates rise suddenly, or if there is a bubble in the tech world, which, did happen in the late 90s and early 2000s. It could be a problem. Obviously, that just kind of seems to be a downside that's possible in most major indexes, because as much as indexes are tracking, the average performance of a group of stocks, humans aren't always logical. Bubbles do happen. So, you just have to be aware of the fact that that's possible in investing, and obviously do your own research before you invest in anything. However, if the NASDAQ is something that interests you, the two most talked about ETFs that I've heard about, and obviously there's more out there, so do your own research, but to just point you in a direction to start your research, there is QQQ, which is from Invesco that tracks the NASDAQ, and you also have ONEQ from Fidelity, two very large financial companies that have index ETFs available for the NASDAQ. So those are the three major ones from the United States that people talk about the most. There are some smaller ones that are relatively important, so I'll cover those, just not as in-depth. But, you know, if you want to do your own research on these ones further, these are just some ones that people talk about. So the first two that we're going to talk about are sorted more by company value, you know. Obviously, companies, some are worth $1 billion, some are worth $500 billion. So the first one that's important to know about is the Russell 2000, and this focuses more on small business, and I'm air quoting small because it's businesses that are valued at $300 million to $2 billion. Which is small in the world of the stock market, you know, that's a lot of money. And the one that I see people talking about the most, or that I'm aware of, just to point you somewhere, obviously do your own research once again. VTWO from Vanguard, I know for a fact, tracks the Russell 2000. I'm sure there are alternatives out there from major financial companies if you want to find something different, you know, and obviously do a bunch of research before you invest in anything. The other one is the S&P 400, which is medium-sized companies with a value of 2 to 10 billion. And the one ETF I know that tracks this for sure, once again, do your own research, there's a bunch out there, is VO, which is also from Vanguard. And as for why there's not a third one here for companies larger than this, it tends to just kind of be like, you know, the S&P 500, Dow Jones. Like, you can find stuff that tracks large cap, it just happens to be that there's a lot of overlap with the three major ones we talked about. And as for like ones outside of the United States, there are ones that exist, you know. I'm not an expert on foreign markets by any means, but just to, if you want to research these yourself, I'm not sure of any ETFs or anything. There's the Nikkei 225, which is in Japan. There's the DAX, which is located in Germany, the KOPSI over in Korea, you know, and you have the JSE from South Africa. Obviously, there's a lot more than that, you know. Most countries with a developed economy will have an exchange, or like, I'm sure in Europe, there's like a EU exchange, you know. Like I said, I'm not an expert by any means on foreign markets, but I do know that those indexes exist, so if investing in like a certain country or region is something that really fascinates you, that can also be something you can do. If you are going to be researching ETFs to like invest in, you know, if that is something that you want to do further research on, then I definitely can tell you like a couple things to look for. I would go watch a further in-depth video about exactly what to look for, but you want to make sure that you keep your expense ratio low. And basically what that means is, you know, in order to make it profitable for them to track the companies and weight it and do all the research and blah, 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 they take a small fee of anything you invest, and most of the time, you know, it's pretty negligible. It's not a very large amount, but obviously different funds have different amounts of expense ratios attached to them, so you want to do research before you invest in an index and just make sure that you're getting the lowest possible expense ratio for the money you're putting in. And beyond that, something else that you want to look for is you want to make sure that there's a lot of volume, and I'm not talking about screaming. Whenever you're trying to buy or sell an ETF, there has to be people buying and selling it, right? You know what I mean? It's important to have an available stock. It's important to have people buying if you ever want to sell it. And so you just want to make sure, volume is the amount of people buying and selling on any given day, that you're not putting your money in an ETF that has like, okay, yeah, it has a super low expense ratio, but that's because only 500 people a day are buying and selling this. You want to make sure that given a situation where you want to buy more or sell what you have, that you're able to actually get rid of it, hypothetically, you know? So those are two things that I just see a lot of people kind of make mistakes on when they're super new to this. Like I said, I would do your own research, you know, go watch other videos from people that are way smarter than me. But that is the basics of index investing, explaining the basics of what the indexes are, what the different ones do, all that stuff. Once again, just to reiterate, because I don't want to be responsible for anybody doing anything dumb, do more research before you put your money into anything. This was the basics of everything. I explained a couple indexes, I said a couple ETFs, but I do not have a crazy finance degree. You're going to want to do your own research, listen to people who got that stuff, videos about each index, the difference between different ones. This is a great place for beginners, but by no means am I saying that you should be out here taking everything I say as gospel. That being said, if you did find it useful and enjoyed it, I would really appreciate you taking a second to press the like button. Let me know in the comments section down below what you thought, and of course, subscribe if you're new and turn on notifications. I do cover stock market news and just basic financial stuff similar to this at this level pretty often, so if you enjoy that, be sure to subscribe and turn on notifications. If you really want to help me out, I'll put a link to the intro song down below, along with a link to my podcast, The Scuffed Cast, or of course, you could use code SCRUBBY at the G Fuel checkout. You get the best energy drink for gamers. It helps me out. Everyone's a winner. And the last link that you're going to find down there in the description is a link to my merch store. So if you want to go pick up a t-shirt and help me out, I definitely wouldn't mind. It's the coolest merch to ever exist. Not that I'm biased. But yeah, that was just the basics of index investing, all that good stuff. Like I said, if you enjoyed, press the like button, comment down below, subscribe, all that good stuff. And on that note, don't get anyone pregnant. If you do, make sure they're hot. And hopefully, I will see each and every single one of you guys next time with another video. I'm out. Peace.